Capital gains tax explained. Short term versus long term. Hook. 0 to 5 seconds. You just made $100,000 profit on a stock you bought 6 months ago. Congratulations. Right? Wrong. The IRS might take $37,000 of that. But if you'd waited just 6 more months, you'd keep $24,000 more. That's $24,000 you literally left on the table by not understanding capital gains tax. Most people have no idea this even exists. Today, we're fixing that. Intro. 5 to 15 seconds. Hey, I'm breaking down exactly how capital gains tax works, the difference between short-term and long-term, and the strategy that keeps thousands in your pocket instead of sending it to the IRS. If you're investing in Robinhood, Fidelity, your 401k, or holding any assets, this video literally pays for itself. Part 1. What even is a capital gain? 15 to 45 seconds. Let's start simple. A capital gain is profit. You buy Apple stock for $100. It goes to $150. You sell. You made a $50 capital gain. That's it. Basic. Now here's where it gets important. The IRS taxes that profit. But here's the thing nobody talks about. They tax it differently depending on how long you held it. Think of it like this. The government is rewarding patience. Hold it long enough, they tax you less. It's literally an incentive to not day trade like a maniac. Part 2. Short-term capital gains, the expensive way. 45 to 330. Short-term capital gains are any profits you make from selling an asset you've held for 1 year or less. Here's the brutal truth. They're taxed as ordinary income. Let me show you real numbers. Say you're a single person making $65,000 a year at your job. You're in the 22% tax bracket. You day trade cryptocurrency on Robinhood and make $10,000 profit in 3 months. That $10,000 is taxed at 22%. You owe $2,200 to the IRS. But wait, it gets worse. That $10,000 in gains pushes your total income to $75,000, potentially bumping you into a higher tax bracket for state taxes. In California, that could add another 5 to 9% depending on your situation. Now let's look at the highest earners. If you're making $500,000 a year and you flip stocks aggressively, short-term gains are taxed at 37%, the top federal rate, plus 3.8% net investment income tax if you're high income, plus state taxes. We're talking nearly 50% of your profit going straight to the government in some cases. This is why short-term trading is actually terrible for most people. The tax bill alone destroys your returns. The only time short-term gains make sense is if you absolutely had to exit for a real emergency. Otherwise, you're just handing free money to the IRS. Part 3. Long-term capital gains, the smart way. 330 to 615. This is where it changes completely. Long-term capital gains are profits from assets held for more than 1 year. And they're taxed at special rates that are almost always lower than your ordinary income. For most Americans, here are the actual rates in 2024. ** 0% bracket. Single filers under $47,025 in income. You literally pay 0 on long-term gains. ** 15% bracket. Single filers $47,025 to $518,900. This is where most middle-class investors land. 20% bracket. Single filers over $518,900. Let me show you why this matters with real money. Same scenario. You invest $10,000 into an S&P 500 index fund through Fidelity. 3 years later it grows to $15,000. You sell and lock in a $5,000 profit. If this was short-term, held less than 1 year, you're taxed at your ordinary rate, 22%. You owe $1,100. You keep $3,900. If this is long-term, held more than 1 year, you're taxed at the long-term rate, 15%. You owe $750. You keep $4,250. $350 difference on just $5,000 profit. Scale this up. That S&P 500 investment grows to $50,000 profit over 5 years. Long-term at 15%, you owe $7,500. Keep $42,500. Short-term at 22%, you owe $11,000. Keep $39,000. You keep $3,500 more just by waiting. And here's the kicker. If you're in that 0% bracket, long-term gains are literally tax-free. Free money. This is why Buffett holds stocks for decades. It's not just philosophy. It's literally the smartest financial move. Part 4. The tax-free loophole everyone misses. 6:15 to 8:30. Here's something most beginners don't realize. If you're investing in a Roth IRA or a 401k, capital gains don't matter at all. Inside a Roth IRA, you can buy and sell stocks constantly. You can flip positions every week if you want. The gains are completely tax-free, both short-term and long-term. Your money grows. You take it out at retirement. Zero tax on any of it. This is why maxing your Roth IRA, $7,000 in 2024, $8,000 if you're 50 plus, should be your first move. It's the government literally handing you free money in tax savings. Same goes for 401 kiloseconds. Though the tax advantage is slightly different. Your contributions are pre-tax, reducing your current income. The growth inside is tax-deferred. Here's the real strategy most wealthy people use. 1. Max out tax-advantaged accounts first. 401k, Roth IRA. 2. Once those are maxed, invest in taxable accounts. 3. In taxable accounts, hold everything for 1+ years before selling. 4. When you do sell, do it in years where your income is lower if possible. This is basic tax optimization. And it saves thousands. Example, you contribute $23,500 to a 401k. 2024 limit. That immediately reduces your taxable income by $23,500. If you're in the 24% bracket, that's $5,640 in taxes you don't owe right now. That same money grows for 20 years. No tax on the growth. That's compound interest running wild. Part 5. Practical moves you can make today. 8:30 to 9:45. Real talk. Here's what you actually do with this information. First, asterisk if you're holding individual stocks or ETFs in a regular brokerage account. Not Roth. Not 401k. Set a calendar reminder for 1 year after you buy anything. When you hit that 1-year mark, you're now eligible for long-term rates. Don't sell before then unless it's an actual emergency. Second, asterisk if you're making money from side hustles or freelance work, and you're investing those profits. Be intentional. Those gains will be taxed as short-term unless you hold them over 1 year. Plan for this in your tax strategy. Visual. Gig economy.